Today, we're breaking down the daily macro landscape, and honestly, we've got a fascinating domino effect to trace. We're going to start way up high with some unexpected geopolitical shocks and follow that exact chain reaction all the way down to, literally, the price of your morning coffee. I absolutely love unpacking these complex webs of data, so let's just jump right in. Alright, here's our roadmap for today's analysis. We're doing a top-down journey. Number 1. Geopolitics and global risk. 2. Central banks taking center stage. 3. Equities and currency corridors. 4. Europe's brewing energy crisis. And finally, number 5. The squeezes happening in metals and agriculture. So starting off with section 1, geopolitics and global risk. Let's look at the immediate catalyst that's sparking today's risk-off mood. The massive driver today is a sudden escalation over in the Middle East. Iran fired the surprise volley of ballistic missiles at US bases. And yeah, while all of the projectiles were intercepted, a geopolitical shock like this instantly triggers global risk-off sentiment. But for the markets, the bigger issue is that it immediately reignites inflation fears, especially through the energy sector. You know how it goes. When risk flares up in energy-producing regions, the market just instantly starts pricing in supply disruptions. Which brings us to a really critical question. How does an overnight missile strike change tonight's Fed decision? I mean, what actually happens when inflation risks suddenly spike on the exact same day policymakers are sitting down to set rates? And that takes us perfectly into section 2. Central banks take center stage. Let's see how they're positioned for this exact scenario. Okay, so here's where the tension is right now. Tonight's FOMC decision is absolutely the anchor event for global markets. The baseline expectation, so the 70% probability here, is for Chair Kevin Warsh to hold rates steady, and he's likely going to stay pretty vague on forward guidance. But listen, the hawkish risk, it is very real today. Markets are pricing in a 30% chance of a surprise 25 basis point hike, mostly fueled by expectations that Fed dissenters, like Logan or Hammock, might push to act right now because of these sticky inflation risks. So, what if that surprise hike actually happens? Well, front-end rates, especially for the euro and the British pound, would likely jump, but longer-dated global rates, they might really struggle to follow suit. And the reason is, tighter financial conditions risk severely denting overall economic sentiment. When short-term rates spike, but long-term rates stay flat because investors are terrified about future growth, you get flatter yield curves. And as we know, a flattening curve is a classic red flag for economic anxiety. Moving right along to section 3, equities and currency corridors. Let's check the scoreboard and see how the markets are actually absorbing all this shock. Looking across the board, global indices are super cautious right now. Major benchmarks are basically just waiting for permission to move. The Dow Jones and the German DAX are totally stuck in these range-bound patterns. Like, the Dow really needs a sustained break above 53,000 to find momentum toward that 53,500 to 54,000 range. India's Nifty is actually one of the few looking constructive, targeting around 24,100 to 24,150. But then you look at Asia. Shanghai has a weak bias, vulnerable below 3,900. And the Nikkei? It's looking outright bearish, targeting 60,000 or even lower. The big takeaway here? Total hesitation. Equities are just holding their breath. Over in the currency markets, things are just as tightly coiled ahead of the Fed. The dollar index, the DXY, is stable in a tight 100.70 to 101.50 range. Euro to USD is locked in this very narrow 1.1350 to 1.1420 corridor. Meanwhile, the yen is still under heavy pressure with USD JPY pushing up toward 16500. The British pound is actually finding some decent support near 1.3250, but honestly, everybody is just waiting for the Fed's gavel to drop. In the sovereign debt space, we're keeping a close eye on today's major auctions. The US is dropping a massive $30 billion two-year floating rate note, while Germany is auctioning €6 billion in 10-year bonds. Interestingly, India's 10-year yield has fallen sharply, though technically it still remains in a bearish posture. All this sovereign debt movement tells us that institutional money is actively shuffling the deck ahead of shifting global interest rates. Alright, let's jump into section 4, Europe's brewing energy crisis. We're moving downstream from paper assets to physical realities now, heading over to Europe where the ECB wage tracker is already sweating over second-round inflation risks. And this right here illustrates exactly why the ECB is so worried. The European natural gas sector is flashing severe warning signs ahead of winter. Current storage is critically low, just 56% capacity. To put that in perspective, the 10-year seasonal average is 72%. That is a massive deficit. And winter doesn't care about your storage deficit, right? The cold is coming regardless, which pretty much locks in the likelihood of elevated prices. And it's really turning into a perfect storm. This storage deficit is colliding with multiple supply constraints all at once. First, Qatar Energy just extended its force majeure for European buyers through September. Then, you've got July LNG imports to the EU dropping by 25% year-over-year. And to top it all off, European heat waves are causing huge spikes in cooling demand, basically sapping the exact energy they desperately need to be diverting into those storage tanks. You can already see this tension in the data. Germany did report a recent month-over-month drop in import prices, mostly because energy costs briefly fell 6.6%, ahead of a temporary US-Iran ceasefire. But listen, do not let that short-term dip fool you. The underlying annual rate is still starkly elevated at 6.1% year-over-year. In fact, if you completely strip out energy, German import prices for capital and consumer goods actually rose for the month. The underlying price pressures have absolutely not abated. Finally, let's zoom in on Section 5, Metals and Agriculture Squeezes. We're looking at the specific raw materials, flashing physical tightening warnings at the very end of our macro domino chain. In base metals, copper is the big standout. It's looking highly constructive, trading above $6.30, and it's eyeing a push towards $6.50. And this isn't just speculative fluff. It is backed by tight physical supplies and a massive surge of speculative net longs on the London Metal Exchange. We're talking over 12,000 lots added. When institutional traders pile into copper like that, it's usually because real industrial demand is colliding with a hard supply ceiling. Now, before we hit the agriculture sector, let's quickly define a term you'll see a lot when supplies get tight: backwardation. It's a market condition where current near-term prices are actually higher than future prices. Normally, you expect things in the future to cost more because of storage and insurance costs, but when that flips, it typically signals a severe, immediate physical shortage. Buyers are essentially saying, look, I don't care what it costs next year, I need the product today. And that exact phenomenon of backwardation is what's driving a violent 4.5% rally in Arabica coffee right now. Prices have surged into pronounced backwardation above 22 cents per pound. Why? Because ICUS port warehouse stocks fell for the 25th consecutive day, putting inventories at their absolute lowest since February. Plus, heavy rains are delaying harvest operations down in Brazil's Minas Gerais region. It's wild to think about, but a weather event in Brazil is directly emptying warehouses in the US and violently spiking the price of your coffee. So seeing this whole interconnected chain reaction from Middle East tensions to European gas shortages right down to physically squeezed coffee supplies, it really reframes our view of the macro landscape. We've traced the path from geopolitical shocks directly to the price of physical goods, which leaves us with this final provocative thought to consider ahead of tonight's FOMC meeting. With energy and agriculture physically squeezing higher and driving up baseline costs, can central banks actually afford to hold rates steady? Are the physical markets going to force their hand? Thank you for joining me for this explainer, and definitely keep an eye on how these dominoes continue to fall.